Let's get started. A lot to cover. We're going to start off top at the macro and then bring it back down to the micro here. So as we start off, let's look at the picture that we're looking at as far as GDP numbers. Second quarter came in above estimates at about 2.4. Now the Atlanta Fed is projecting for Q3 to come in at over 5.8 actually, which is double what some of the major institutions are looking at. So as we get into Jackson Hole at the end of this week, we go what the Fed is looking at, GDP numbers, looking pretty growthy. Now, that being said, there is just a wealth of information, no pun, to go over here. So let's look at what the Fed is actually doing. Speaking of the Fed, they're no longer buying treasuries, they're selling them. So what does that mean? Well, the recent auctions that we've seen here, and you wonder why rates are going up, which we're going to get to, one of the reasons is not a lot of demand for our paper, for our bills. This hasn't happened very much, but you see really no demand from China or most of the BRIC countries who are looking again in trade of energy and as such in, let's say, the yuan or the renminbi, anything but the dollar. So what is that doing? When people and countries are not buying our treasuries, rates go up, right? It's a supply-demand situation. They got to pay more. And so you see rates. Now, speaking of rates, we're looking at the 10-year, which is at a high. I think we have to go back to 2007. So it's getting pretty high there, the 10-year crossing well into the fours there and as such. And what you've seen is, so far this year, we've talked about, excuse the wonkiness, the inverted yield curve. Well, the long end of the curve, right, the 20, 30-year plus, the deep end of the pool, if you will, rates are going up as well. And certainly you would have seen in some of our strategies, especially active capital preservation, which focuses on fixed income, except for last year, essentially maneuver out of the long-term duration assets. Now that may change, but right now, that's kind of where we're at as we do like the short end of the curve. Now, that being said, bringing it back into the economy. Now let's look at some pretty dire stats before we get into the actual equity markets. If you look at essentially just the state of the economy right now, home prices all-time highs. You know, the average mortgage now has gone up from what was $1,600. Okay, not too long ago, to $2,800 a month. And we're not talking about 5,000 square foot homes here, folks. As far as when you look at debt, just an amazing numbers here, not in a good way. If you look at the mortgage market, over 12 trillion. And then if you look at the auto, credit card, student loans, all over $1 trillion. These are all record highs. In fact, household debt, 36%, okay, have more debt than they do assets. So these are pretty dire times economically when you look at that end of it, and yet you are still hearing, because of the GDP numbers I mentioned and the sticky job market, that the Federal Reserve, there are still some hawks flying out there saying that we could see another increase or two this year, while there are also many think that Jerry's going to come out, maybe not as scary as last year when there's a lot of fear going to the meeting like this year. That may be a bump. But if Jerry goes a little spooky on us and gets real hawkish, again, that is what we are looking at as far as a hedge as well. Now, speaking of hedging, when we get to the markets, the major indices, after a nice start to the year, have all pulled back, especially the S&P and NASDAQ, the leaders this year, have fallen below their 50-day moving averages. Now, not to get too technical, but as you know, the 50-day moving average and the 200-day moving averages, a lot of talks about golden and bearish crosses when one goes over another. Which way are we going, Jonathan? Well, let me just put it into perspective. The 50-day has been broached. However, during strong uptrends and bull uptrends, that's not always an issue. Right below the 50 we have on our radar is the 100-day moving average, which a lot of institutional traders look at as well, and the market had a decent bounce at the end of last week off that level. So we are watching as we do begin in some of your strategies start to hedge up on batten down the hatches at the same time, maintaining opportunistically beta-oriented, higher risk, that is, as well. So it is a balancing act. Huge earnings coming up this week. We generally don't get into the individual stocks, but we will this week. NVIDIA, obviously, is a bellwether. It is the proverbial elephant in the room. Now, many of you have seen NVIDIA and have done decently well this year, we'll say. We have trimmed exposure after the huge run, and this month obviously hasn't been good for NVIDIA over the last rolling 30 days, and the Magnificent 7, which we'll get to. It's a huge earnings, and they have a high hurdle. So I'm not going to get into the actual granularity of the growth numbers they have to hit, but huge. If they hit it, could be a momentum move, and if they don't, could drag a lot of the tech stocks down, which is why I mentioned the individual name. So again, we are surfing around this wave. Again, we have the proverbial drone in the sky as we look to maneuver around this huge earning situation midweek, along with Jackson Hole that we already mentioned with Jerry and the Fed's having a good time out west, and as such, a huge week from that standpoint. Now, the Magnificent Seven that we just had mentioned, you're looking at your Microsofts, your Apples, your Googles, I still call it Google, your NVIDIAs, right? Your Amazons, your Teslas, and as such, those and the Metas. Can we forget Meta? Is Threads up yet? I don't know. Everyone's still using X, Twitter, I guess. But anyway, those seven, obviously, the only ones positive over the last rolling 30 days have been Amazon and Alphabet. All right, I'll call it Alphabet once. The Googles there. Everything else has been negative. So you've seen a rotation out of tech, energy and healthcare doing well. You've seen some of that in your strategies where we've maneuvered into the cyclicals and as such. However, we want to make sure, again, when there's a handoff of the baton, it is shades of gray rather than black and white. So to summarize, again, pretty tumultuous week here with a lot of star-studded things to look out for, so to speak. The economy, it really is a bifurcation, almost of the have and have-nots, if you will. Economic growth looks strong, job numbers sticky, PPI came in hot, warmer, let's say a few weeks ago. Rates have spiked. Few things to look at there. The last thing I will mention in summarizing is the U.S. dollar, which was real strong last year, bad for the markets, has been weak versus the euro, the yen and as such earlier this year, but has perked up. Now, of course, the dollar, as rates go up, will get stronger. There is foreign investments that come in, spiking the U.S. dollar, even with some of the constraints, as we mentioned, with some of those other countries using alternative currencies for commerce. That's for another episode as far as the big picture of that. For now, what am I trying to say? Keep our hand like Linda Blair, 360 on a swivel there as we figure out the macro-micro dynamics there. Very, very, very intriguing. Usually a sleepy time of the year. August, by the way, the lousiest month of the year when the market is up 10% plus going from July to August as well. So this generally is, thus far, looked at as a correction within an uptrend, but a lot of landmines around. So we are taking every precaution, and we will stay eternally vigilant. If you look in your accounts, you can see that. But right now, a lot to watch. So with that being said, as football season nears, the market's there's no off season for the markets, as you know. The helmets are always on. Sweaty training camp, that's the markets every day of the year. That being said, stay frosty. Allow us to take some of that toxicity from you. If you have any concerns or questions on your individual risk appetite or your individual accounts within this environment, feel free to reach out to your personal wealth advisor as I discuss these dynamics with clients as well. It is never ending. With that being said, until next time, again, stay cool, stay frosty. We'll talk to you.